Hello, everybody. My name is Joe Fahmy. I'm here with two of my good friends for a trader talk. I'll introduce very quickly Brian Shannon, one of the sharpest technicians I know, founder of alphatrends.net, and also Jon Najarian, star of CNBC's Halftime Report and co-founder of Market Rebellion. How you guys doing?
Doing well, Joe.
Thanks for love the hat, John. Love the hat. Always got great hats.
You know, when I got nothing on top, Joe, I got to have a hat. I'd wear it on CNBC if they'd let me.
I know. These might be three of the best ball traders that I know. Or at least two.
We are the baldest traders.
Yeah, exactly. John, let's start. Something I've been wanting to ask you is I have seen, I know you're the master, you and Pete, of following unusual option activity. I have seen Nonstop paper in like not just the NASDAQ 100, the top 10, the FANGs, the Microsofts, and so forth for the last 3 or 4 weeks. Not like 10, 20 contracts, like 10 to $100 million worth of contracts. And I just wanted to kind of get your opinion on that, what you think about it, what, how you're interpreting that, what you're seeing.
Well, and you're right, Joe. So for instance, this week, on the 31st of August, last trading day, we split both Apple and Tesla. And so, of course, if you've got 5 times as many shares in Tesla, 4 times as many shares in Apple, of course, volumes are going to be high. We all get that. If the same dollar amount traded as Friday, you'd have 5 times or 4 times as many contracts probably changing hands.
Sure.
But it's accelerated way past that, Joe. And you're right, it didn't just happen this week. But there are so many of these day trading people, whether they're, some people say kids at Robinhood, and maybe they are. And others, like Davey Day Trader was not a Robinhood trader.
Correct.
He was an E-Trade trader. And then he became a Trade Zero, I think, is where he trades through now. At least he seems to be talking nice about them a lot, so I'll figure that he probably trades through there. But the volumes of trade are staggering, and some of it is, I'm not the first, none of the three of us will be the first to say it, but there's no sports hardly to bet on, Joe. I don't know how many people are making book on these NBA games or NHL or Major League Baseball because it's so odd.
Brian's been getting down on ping pong in Korea from what I hear. That's what he's telling me.
That's actually true, yeah.
I mean, think of it though. It is so difficult as it is to get a competitive line out there that you can get two-sided wagering on, because that's what you're looking for as a bookie, right?
Right.
And all of a sudden you've got, if a bunch of money came in on the Lakers tonight, would anybody want to bet against it? Because you don't know what the deal is. I mean, it's got to be the ultimate rigged bet, rigged game in sports right now, because there are definitely people who know a lot more than bettors do right now about what's going on. And I'm not talking about canceling games. I'm talking about, people not feeling well and all the rest. I mean, I think people think they're getting a fairer shot betting on stocks, as rigged as they may be, versus betting on sports. And so I think that contributes to it. How about you, Brian?
Well, you know what, John, I was going to ask you 2 things that stood out there. One, so you are seeing that, Joe mentioned the volumes, but you're seeing it is, in fact, the dollar amount as well, not just because of a split. One thing I wanted to ask you about options is, what I've noticed, I'm a call buyer a lot of times. We're in an uptrend, so I buy premium, and I've noticed that the VIX has been coming down, and everyone says the VIX is the measurement of the how expensive options are. I've noticed they seem to stay expensive to me. They more so than maybe they were a year ago for if we're in the same type of situation. Do you think that's because of this big demand from new sources for mainly calls as well, that the OEX is outdated and the VIX is outdated, that we need a better type of volatility index?
That could be, and there are, there's a NASDAQ VIX and there's a Russell VIX, but you're right, volatilities are still high. Pete and I were talking about it this morning. We were looking at the VIX Wednesday last week, guys. It was 2144. That was the low Wednesday last week. Today it was 26, so that's 27% increase in the past week. And that's with the S&P flat, over the same period of time.
How do you interpret that, John? Because a lot of people have asked me that. Market flat rising with the VIX rising.
Hedging. So I think it is, Joe, that an awful lot of people were hedging, meaning, when they come in to buy puts against their Apple or against their Tesla or against any stock, they end up lifting, vol. Now, obviously, when they come in specifically for the S&P 500, that's what gets reflected in the VIX, because, it's not the OEX anymore. It's the, it's the 500. So,
okay.
But there's so many stocks in there that I think people want to put a floor under after this run. And I think we all three of us probably know this guy, Stevie Vicks, on Twitter. He's funny guy.
I've heard.
Yeah, he's like a volatility trader. And Stevie was saying how ludicrous it was this weekend. He was, basically heckling the folks about, hey, this is the craziest move in the market. Can anybody explain to me why the market is up and the economy's on its ass or whatever? And I said, capitalization weighting. I said, I've got two words for you, Stevie, capitalization weighting. And then he came back and said, what was it? Expansion, whatever. Anyway, he was basically saying that, hey, it's the whole index is expanding when you've got Apple trading where it's trading. It's not just capitalization weighting. That's what, the S&P is responding to, but what about Apple?
Right. Real quick, Brian, to your point about premiums being higher, I just thought about this with the VIX still low at about, but let's say in the low 20s, call it 25, it's still double what I consider to be like a really low VIX around 12. Yeah. So, like when you're in one of those like 2017 really slow grinding, minimal volatility markets, correct me if I'm wrong, but John, the VIX would be like 10 to 14, right? In those range. So even though the VIX is relatively low compared to where it was a couple months ago, still, wouldn't you consider 25, in historically still pretty high?
Yeah.
So maybe that's why the premiums are higher. I don't know.
Yeah. And I think it's also, Joe, it's everything from the election to the stimulus, if and when we get it. And by the way, history won't be kind to Congress for shutting down the economy, along with, states and the president and whoever else we want to blame, Santa Claus, for, shutting down the economy.
You can't blame Santa Claus, no.
When you've got them now dragging their feet on providing some sort of stimulus again. Because I don't think any of the three of us want to see them print a hell of a lot more money, and it's going to, have a $1 trillion on it, whatever they do. But when you shut down people's businesses, I mean, Joe, you live out in, New York City. I used to visit there once, go there once a week and stay for a few days. Brian's out in God's country, out in Colorado. But New York, I don't know how New York, obviously it will survive, but it won't look the same if you've got all these restaurants and businesses dying, and most of them have died already. It's got to be getting over 50% have already died, Joe.
It's a resilient city. Unfortunately, just to be realistic, it's going to take some time to come back. It's going to take longer than I think.
Years.
I mean, it's just, I mean, there's so many people, unfortunately, in the service industry. Broadway's shut down for a while, which drives a lot of traffic. Times Square is a ghost town. It's just sad, but it's a resilient city. It's just a matter of just time. It's just a matter of time. The other quick question with going back to the option thing is that, do you think it's a fund? Because when I start to see, you know, $10, $20 million, I know Robinhood traders, you're absolutely right about they're in there buying, and that's why a lot of the call, you know, equity call, put call ratios are high or low, I should say. But my point is, like, do you think there's just a fund that's behind, or maybe because the option markets are so liquid, it's a way rather than buying 500,000 shares of Apple, you can just buy 5,000 contracts because they are liquid?
I think a lot of that goes on, Joe. I do a podcast that I'm going to have this guy on from Gammon Capital. And gammon as in black gammon, as in, you know, when you turn the die and you increase the bets and things like that. This guy's up 600% through June. And it's not a small fund. I mean,
wow.
It's not like a $10 million, $20 million fund. There's no shame in operating funds that size. But I mean, this guy is running a massive, his name's Michael, I'm sorry, I forget your last name. It's like Michael Mesner or something like that.
Okay.
But anyway, he runs something called Gammon, and they were up 600% through June, Joe.
That's
so
nice.
Yes, there are some funds out there that are really increasing dramatically the amount of money that they're putting to work through derivatives.
Okay.
That's nuts.
Brian, I want to ask you, because you made a great point. I forget if it was we were talking or on a call or in one of these trader talks. Everyone says this is going to end badly. That's what everyone keeps saying. And you made a great point, and which resonated with me, which was it doesn't end badly if you have risk management, know what to look for, and you know, at least have. I mean, if you could elaborate, because I thought that was a very good point that you made.
Well, I think it's like any of these, you know, phrases like sell in May and go away. Everyone's making fun of that one right now because the market just rallied 20+% from May. But, you know, when they say it's going to end badly, what does end mean? There is no end game, number one. You know, the market is always going to be there and it continues to morph and evolve. But I think that what they're saying is that, you know, when this rally ends, that it's going to catch a lot of people off guard. And, you know, rightfully so. We've got a lot of new participants in the money, and certainly the uneducated people with less experience are going to get hurt the worst because they're used to the mantra, buy the dip, buy the dip, buy the dip. But no one tells you, well, maybe this time it's not a dip. You've got to experience these massive drawdowns. And then when we have the market decline huge, like we did in March, and then all of a sudden it comes all the way back. And now all the people who held through that have this bad habit thinking that, well, it does always come back. So for people who don't have a risk management strategy, things are going to end badly, I think. But if you have a disciplined approach, a consistent way of, you know, proper position sizing, and then getting out of the way when there's certain events, or just, you know, stopping yourself out before it becomes too big, that's what, you know, smart trading is all about. If you're a smart trader, it doesn't end badly. So I just, you know, you see these phrases thrown around, and it just doesn't make sense for everyone out there. And it's a rally cry to, you know, if you feel like you're part of that crowd, then get educated, you know, do something about it. Don't wait for it to happen. It's happened once this year. Don't let it happen again. Be proactive now.
Yeah, I mean, it's a great point. And the other thing I just thought about is, I mean, we were around in the late 90s trading, where my view is it was people looking to trade and who were looking when all these online brokerages were becoming popular, where now, I'm not saying it's not a bubble or whatever the word is. I just think it's more people forced to trade because, to your point, John, no sports, you know, sitting at home, the average deposit in Robinhood's $1,200, which is the stimulus checks or whatever, you know, like, so I think it's a little bit more of people with no choice versus actively looking to get into the markets. I don't know if that has something to do with it or not.
Yeah.
Zero commissions.
And I think, Brian's right. Commissions.
Zero commissions.
You know, which is why so many of them can effectively do day trading, Joe and Brian, because, when commissions are zero, when Ken Griffin is paying for your order flow over at Citadel or over at Wolverine or over at DRW or Virtu or Jump Trading or wherever, the flavor of broker you trade through, everybody's selling it. There is nobody who isn't selling it, including Interactive Broker, unless you're on their pro platform, and then they charge you a lot more. So, I mean, virtually everybody sells order flow because, as somebody once told me, when, this is a, game theory kind of guy, Joe, he would say, when you give an order, when you put an order out there to be hit or to be taken or whatever, you're giving people information for free. They know that, that they can hit that before you can cancel. And you're not getting paid for that. So you're a fool. I mean, in their minds. The three of us don't trade in nanoseconds. All three of us probably hold trades for longer than a second and a half. But none of these high frequency guys do that.
Right.
They're in there, to take that very, very quick scalp. And so, yes, there is a lot of edge that they capture just by being so much faster than all of us collectively are. But that's a different game. None of us really want to play that game. It's super expensive. You got to have a team of scientists basically working with you. It's not like somebody just buys an off-the-shelf high frequency trading apparatus and just lets it run, and it's like a mining thing for Bitcoin. It's not at all like that. They got to be feeding these guys, hundreds of thousands of dollars a month, and then you're buying the order flow also, because that is that's the accelerant that you put in there, is the order flow that you're buying. You need people that are slower than you, that are feeding you stuff on the bid or stuff on the offer, and that's how they're beating us all the time. But yeah, I think commissions have a lot to do with it, Joe.
Okay.
And Brian.
Another thing that I was thinking about recently is I don't know, maybe I just was ignorance is bliss in the 90s and it was just a bunch of us and we were having fun trading and all this stuff. I've noticed a lot of frustration, a lot of people. Usually you get frustrated and angry when the market's going nothing but down, not when it's going nothing but up. And my I guess I whatever, I count that to either people who have not participated or that are just frustrated because they sold too soon and things keep going higher. And I'm a big fan of talking about market psychology. I'll start with you, Brian. What are your sort of, I know you deal with a lot of, your members and so forth that ask you, how do you, coach people, or, what's your advice to people like that deal with that?
When this rally first started coming back around, I was highly skeptical. I was getting ready to write a blog post about how, similar to New York City, it's going to take a long time for the market to come back. Thank God I never formulated my thoughts and made that blog post, because I was dead wrong. And instead, I focused on, the only thing that matters, price action. I started looking at it and saying, hey, well, these stocks are moving. Now I'm seeing more stocks setting up. I mean, Joe, even yesterday, someone said on Twitter, like, hey, there's no good setups anymore. I said, okay, here's one. It's a little company called Netflix. It's a perfect bullish flag. I mean, you can't get more basic of a technical pattern and more bullish than that. And then it rallies, 5% or so today. So the opportunities continue to present themselves if you're doing the work and if you're willing to say, hey, I've got to listen to the only thing that matters, price action. Otherwise, the phrase I always hear is, it's better to be on the sidelines in cash wishing you were in than it is to be in and wishing you were out. Well, that goes for the same as short sellers too. I mean, I can't imagine what the heck any short seller is doing in this market.
Yeah. It's got to be torture. I mean, I mean, John, what do you tell people who come to you and I know they approach you all the time and they say, you know what, I've been out since March or I sold at the lows. Like, how do you, recover from that? Or, I mean, I know there's not much you can really, do, but I mean, a lot of people, unfortunately were stopped out because the news was horrible and they didn't do what Brian and what we've done, which is pay attention to the price action. What do you tell people who have been sort of on the sidelines?
And that's actually a really easy answer. And it's something that I've shot to our friends over at Bloomberg a lot.
Hire Jon and Pete Najarian. That's the answer.
Tom Keene, John Farrow. I tell these guys all the time, whenever they say, well, this is the most hated rally ever, I say it's only hated by people who aren't in.
Right.
I mean, and that's not to say that I'm always long. I'm a bull. I have been bullish like Brian and like you, Joe. And, we're traders also. So what Brian said there, folks, you should take it to heart. And that is, he had a very logical examination of what was going on in the market. And he said, boy, based on this, based on 1987, based on 1998, based on 2001, based on 2007 through 2009, all of that history, not that Brian's that old, but all of that history usually mentally screws with people to where they can't just get back in, right? But we never locked them in at home before. We never just said, okay, it's the match game or it's freaking CNBC. Which do you guys want? It's Netflix and another John Travolta movie, or it's CNBC. I mean, you lock these people at home. They have a little bit of money. They're working from home, the ones that, didn't get furloughed. If you were unfortunate enough to be in the hospitality industry, and none of the three of us probably know more about that than Joe Fahmy, because he has so many friends, Bri, out there in Vegas when he was working there. And it's not just hospitality. How about all of your friends, Joe, that you've been nice enough to introduce me to in the music industry?
Yeah.
What about Slash and Axel and all of these guys? Because Joe knows these guys.
Well, I think they're going to be all right. It's the
they'll be okay. But they're not making any money right now.
I know that in general, if you're not a big superstar, there's a lot of musicians not only struggling, but they don't make money from selling records anymore. So you have to tour. And just like I said, Broadway's pretty much closed as far as I know till middle of next year. Well, touring, you don't just say, okay, we have a vaccine, let's tour, October 1. These things take 6 months of planning. I mean, they canceled CES, the Consumer Electronics Show in Vegas, which is in early January. They canceled that in June because you have to plan things 6 months in advance. So my point is, they're not going to be touring till at least the summer at the earliest, and maybe end of 2021.
Right. Well, so to your question, Joe, as far as, what do you say to somebody like that? I always tell them it's only hated by people who aren't in. But again, look at what Brian did. And hello, Irusha.
Hey, what's up, man? How are you doing, John?
Irusha gets a haircut.
Yeah, exactly.
Joe had just posed the question, Irusha, and Brian started off with the answer, which was that he had written this blog post that he was going to put up about how, God, it's really, this could be a long time. Maybe it does V-shaped bottom, but it might take, that the angle on that V might be pretty flat for a long time and blah, blah, blah. And then he said, though, good thing I didn't write it. Good thing I didn't post it or whatever. But I would say also, Brian, that you're a trader. So if you did post it and all of a sudden the world changed like it did, all three of us, now all four of us, would have said, yeah, I'd expect Brian to change his outlook. I could be wildly bullish on a stock or wildly bearish on a stock. And I was bearish on Netflix at 300 or whatever. It dropped and then it just went racing to the upside. And Mark Cuban came on air and told me I'm stupid I got right back in and I've traded it since then. But I've been on the wrong side of many, many trades. But since you're a trader, you flip. When you're wrong, you say, okay, I'm not willing to die on my sword. I'm saying I want to, do the right thing and get on that momentum. So I think, Brian, what you described was doing exactly that. You could have a very strong outlook that was exactly right, but if the facts change, you're going to change like that.
I want to introduce
Irusha. John, you see that more than anyone. I mean, people are, when you say something on CNBC, I know you're a trader and you're talking bullish, and then people say, oh, look how, stupid that person was or whatever. They said they were bearish. So, whoa, wait a minute. We covered our loss. I'm not going to take this thing to the grave. Are you kidding? So it comes down again also to, Joe, know who you are in the market and what's your time frame. If you're this global macro investor who needs to look at the relationship to the dollar and what lumber's doing and the housing starts, then fine, create your global macro theory, but you have to trade price action still at the end of the day.
Yeah, I want to introduce Irusha really quick, but to stress on that point really quick is one of my favorite lines from Stanley Druckenmiller is he says, and I'm paraphrasing, is one of my greatest assets is that I can change my mind quickly. Right. And I think people don't realize if, Brian, you got tons of followers, John's, on TV with a lot of stuff. Irusha's a superstar in his own right on IBD Live. And we make calls or we have opinions on stuff, but people don't understand we can be flexible and we change our minds based on, the price action. So I'm glad you stressed that point, Brian. For people who don't know, Irusha is the product manager at MarketSmith, superstar of IBD Live. What else can I say? He's got 99 problems, but getting rich ain't one.
Oh, man.
He's the best Oakland Raiders technician fan I know. Anyway, Irusha,
Las
welcome.
Vegas Raiders now.
Las Vegas.
You
Sorry. Yeah, I should know that. How you doing? How are things?
No, things are well. I mean, this is, and you guys might have spoken about this before, but this market's insane. I've been saying that for 3-4 months, and it's kind of like what Brian and John were talking about here. I have been wrong so many times this year on where the market's going, but I just listen to the market. It's the market is right, and I just listen to it. And it's like, okay, I'm wrong once again. Just listen to the market, and we'll just go and just go with the trend. And today it just got even more ridiculous. And who knows? The market's always teaching wonderful, wonderful lessons. And the sooner you learn to listen to the market and learn from the lessons and learn from your mistakes, that's how you're going to really get on the right side.
Yeah, we talked to Irusha when those follow-through days came in early April. We were joking that, okay, institutions are showing signs of coming in. And Brian, before you hopped on, was talking about he was going to write a blog post like, I don't buy this. And we were talking about this isn't for real. But that's a perfect real-time or fairly recent example of, we've all collectively, been in the markets over 100 years collectively, and we might have doubted that, but you have to be flexible, and we were able to change our minds.
I've got a good one for all three of you guys and all of you who are watching Joe's podcast and listening to it. I had a company that I started in 1989, and I called it TMAR, T-M-A-R. And it stood for the market's always right.
Love it.
And, because it's just like Joe and Brian and Irusha have said, I'm not going to stand there and basically piss in the wind. I'm going to piss with the wind. I'm going to piss the direction that the wind is going, Joe. I'm not, because otherwise the piss comes back in your face. Which is that's not a good visual, I know, but imagine that every time you're fighting the market.
I was going to say all over your ski bibs, John.
Wouldn't you rather, wouldn't you rather go downhill on the skis, Brian, than go
Right.
uphill on the skis? Yeah, you can go off of a jump and you can, make little uphill moves and things like that, but you want to be going with, the easiest flow. And for most of the last 5 months, that easiest flow has been to the upside, absent that really sharp decline that we had in March, it's been to the upside. And if you're somebody who decided to fight it, my God, what was Zoom today? Up 38%?
Yeah, something like that. Yeah.
I
Somebody
love that. I love
figure it
that
out.
story, by the way. I love that whole Zoom story about he started at WebEx and he wanted to make the changes when Cisco bought him, and they said, no, we don't want to. So he said, screw you. And he did it on his own. And now just Zoom alone is worth, well, it was half. Now it's worth 3/4 what Cisco is.
Wow.
And apparently 40 people from Cisco followed him to when he started Zoom. That's how much of a huge following he had and loyalty there.
Yeah, he was trying to get in touch with, he wanted a better product to talk to his girlfriend at the time, who's his wife. And, power of love, power of, now I'm going to start, Huey Lewis.
Huey Lewis.
But my point is, it's just the power of, I love those stories. I love stories where someone says, screw you, I'm doing it on my own.
Yeah.
So those are powerful determination stories. And he's got to be worth what? He tacked on another $5 billion today or something.
Yeah. Well, I mean, talking about going on your own, a lot of people who are going to watch this and all of the guests here on the show, we've all kind of gone on our own versus the mainstream kind of investing kind of wisdom that's out there. I remember 20 plus years ago when I got hit in 2000, I started realizing, wait, maybe buy and hold is not for me. I don't necessarily like riding everything down 80%. And so having that kind of guts to say, let me try to figure this on my own. Let me learn from others who've done it. That takes a lot of guts too. And it also does take a lot of time to go through kind of the learning curve and learning from your mistakes.
Yeah, Brian was talking about that before he hopped on about just, when people say this ends badly, he says, not if you put in the work. And if you have to put in the work. And that's basically what you're saying is you were sick of something, you wanted to make a change. And Brian brought that point up very, it was just a great point. Like you have to work at this. Yeah.
I mean, the one thing that I generally tell people is the ones who really end up putting this together, and this is kind of what Brian's saying, is the ones who just hang around long enough. They pick themselves off the mat over and over again. And then finally they find themselves in a crazy market like this where you just have to be there. You don't have to be a genius. Just be there. Buy some stocks and just ride them up. It's a very unusual market. This is once every 20 years or so. But you have to survive long enough to participate in this.
I mean, I think a little ignorance is bliss would help. Sometimes if you know too much, sometimes I know those are some of my mistakes because I know I did better in 99 when I just really had no clue. I still have no clue. I just have a little less. But this, like Fidelity said something like their best accounts are the people who died 3 years ago or something like that. They said, oh, Mr. Jones hasn't made a trade in 3 years. Well, because Mr. Jones passed 3 years ago. Well, he's up a 1,000,000%. So, I mean, it's almost like you're better off just not looking at your screens all the time because,
Sounds like he owned Tesla. Or Zoom.
Yeah, he had 80% in Apple and just let him rode the whole thing.
Think of that, Joe. Everybody, just think of that for 1 second. Apple, December 2018, broke 150. Now, after a 4-for-1 split, it's heading right back there. After a 4-for-1 split.
Yeah.
That's not 2 years ago, Joe. This is the biggest company on earth now.
What about Musk with his 420 funding secured? And that was a joke. It's 500 now after the 5-for-1 split. He got the secured after a 5-for-1. He got 5 shares secured for every one he was talking about. I mean,
briefly today, he was worth more than Zuckerberg. At one point today, Irusha was probably feeding those lines to the folks at IBD. He was richer than Zuckerberg. He was the 3rd richest human on the planet Earth.
How cool.
Imagine that.
It's
The
incredible.
third
If
richest.
he gets close to Bezos, you're going to see a 40-for-1 split if he gets anywhere close to Bezos. I love Chris Rock's line that Jeff Bezos is so rich he got divorced and he's still the richest man in the world. That's such a great line. I also want to give the viewers just a common question. I just had it in my notes here. If anyone wants to talk about position size, that probably, I'm sure Irusha, you'd say the same thing. It's just probably one of the most, top 2, top 3 questions. When you guys are getting into, I know it's different, John, with options, but let's say you are looking to buy, a stock. What are you looking at as far as, what do you tell people what they're comfortable with? What type of position size? Anyone can answer. If you want to start, Brian.
Yeah, I mean, there's so much personal to that, in terms of, there's so many variables. What's the market doing overall? How correlated is your stock to the market? What's the beta of the stock, a small biotech versus Amgen or, something more established. I generally, for me personally with my swing trades, one of my strengths is that I'm really good at identifying the proper entry point. And I generally feel like I've got this one now. So I tend to go in a little bit, maybe irresponsibly heavy. And with the intent, though, that I'm going to...
I like that expression. Go ahead.
With the intent, though, that I'm going to peel some off really quick. And when I say really quick, I'm talking about, a $25 stock goes up 25 cents. I'm taking, 10% of it off. And then I'm taking a little bit more off into that strength just to get myself back to a normalized position. But now I'm dealing, from a greater position of strength because I got in, large and I can hold more of it. So to me, it's about the quality of entry and where the overall market is. I'm personally willing to go in, a little bit heavier than most people will tell you should.
Okay. But you know what you're doing and you can make decisions and you're fine doing that. And I think
it's not something the new guys should be doing, but unfortunately I think they're going in really irresponsibly.
I find that people either have way too many positions and tons of tiny ones, or it's one extreme or the other, or they're just loaded 80-90% in one stock and they're just, they can't sleep at night. John, you do what, like a mix of stocks and options, or is it, a little bit of both, or mostly options, or?
Almost any stock position I've got, guys, I'm sitting there hitting it with options. So like right now, I've got Apple. Apple's been on this, wonderful run. Yesterday I was, after the split, I bought at the money calls, sold twice as many above the market. It's a repair strategy, we used to always call it, but you don't have to be fixing something to do it. So in other words, I think yesterday, Joe, the numbers for September were something like that I was buying the 130s for 5 and selling 2 of the 135s for 3.5. So I was collecting 7 against paying 5. So I've got a $2 credit for that. And I'm not naked at all because I've got stock.
You own the shares too, correct?
Yep.
Okay.
Stock surrogate at the 130 strike, short twice as many calls up here at 135. And I did the same thing today out in October. So I like to ladder the positions so that I have some stuff that's right in front of us right now that's just 3 weeks out or 2.5 weeks out till expiration, and some stuff that's 6 weeks out like those Octobers. And I got a much bigger credit for that today. So I agree with you that you don't want to have too many small positions, which is, that's the curse of not being in the market as long as the 4 of us, and maybe not making money over as many years as the 4 of us, because like I think Brian or Joe had said that the average Robinhood account was $1,200 or $2,300 in that range. That's not enough to have any diversification. You're going to be long or short, right now. You're not going to be
the whole thing. Yeah.
And quite frankly, you'd be stupid to spread that around. You can't. What are you going to have? 1.5 shares of this company and 4 shares of that and so forth. But they still do have to understand how much money they've got to play with, and then the appropriate size, to Brian's point. So, if I say that all the time to people that say, well, can I quit my job and trade for a living? And I said, how big do you live? How much, if you live Joe Fahmy kind of big, where it's, 100,000 a month, well, then you got to have several $1 million account.
100,000 a month. I can't put gas in my plane at 100,000 a month. What are you kidding?
If you need, for instance, if your job right now is paying you 200 grand and you want to duplicate that through trading, without taking extraordinary risk, you really do need about $1 million. If you have less than that, you're going to be pushing really hard, because you don't have the experience probably to be able to sit there and with 200 grand make 100% return every year, and you're just back to where you were before, except I guess you're calling yourself your own boss. But that'd be a lot of stress. On the other hand, if you have a $500,000 account and you said, can I make 50 and have, a great life and do this? Oh, hell yes. You can probably make 50 to 100 with a $500,000 account. But, if you want to quit your job and live a Joe Fahmy lifestyle, you need $2 or $3 million to be able to, make what Joe needs to live on in New York.
I don't have that big of a drug problem. It's not that bad. Don't they say for people who want to trade on their own, I forget if it's like the standard is 1 or 2 years of expenses in something like in a savings account that you just won't touch. So at least if you have some ups and downs from trading, have you guys heard something like that, or at least put aside, so you have that secure so you don't have to stress from your trading? I don't know.
I've never really heard it. It makes a lot of sense.
Yeah.
Yeah. Irusha, with position size, that probably is a question, especially with the IBD style. Me personally, I'm a fan of, if I manage money for clients, 5%, having 10 to 20 positions, a concentrated portfolio as far as stock goes. But if you want to answer for individual, what do you tell people when they ask if you get that question?
Well, the kind of the traditional answer is you want to try to build up to a 20% position. So you don't start off like that. You're gonna let the market tell you which ones are working. So you start off a lot of times with a 10% position. Now, if that's up 2%, now you're adding another 6% to it. And if it's up another 2%, you're adding another 4%. So you let the market slowly pull you in. And that's kind of the ideal way. And the reason why that's important is you're not letting your own biases dictate, hey, I like Zoom versus Tesla or whatever. If it's crossing those pivots, it's telling you to get in at that point, you like that company, you put that money to work, and now you're letting the market tell you what to do. So that's how Bill O'Neill did it for years, and that's how a lot of times he would find himself in the very best stock with a super concentrated position because he just keep adding and adding to it for the ones that work.
So maybe you buy 10 and then the ones that are kick out the weaker ones, and all of a sudden you're left in 1, 2, or 3 really concentrated ones.
Yeah, now and that's kind of the ideal way, and that's for years a lot of times that's the way I did it. This year I kind of took a little bit different approach where I try to most of my positions are around 8 to 10, so they're a little bit less. But what I've found, and this is also because the market is just super strong, is I've been able to handle things a little bit better with a little less concentrated position. So when they're pulling back, I haven't completely gotten out of some of these stocks. I've lightened up. And then when they pull back to a key support area, like the 50-day moving average, now I'm slowly adding back to it. So I've been able to go with the ebbs and flows better versus when they're more concentrated, I would just get more emotional to it. So that's how I've just kind of handled it this year.
I think that's great. 1, because of self-awareness, and 2, the lesson there is you're just doing what works for you. I know some people that can put their whole account in 2 stocks and they have the stomachs for it. I know some people that would vomit if they did that. So you just have to do, I think Brian even made that point earlier. It just, it's a personal thing.
And also that that also will take a few cycles to go through, making those mistakes. Okay, I went too far. I got too emotional. I only was able to I couldn't handle a 2% pullback. And now I'm too light. It's not getting any effect on my portfolio. So yeah, you kind of go back and forth to try to find that. So in the end, even with the system we talk about, the Can Slim system, it's the way I look at it. You learn kind of the larger strategies, and then just make it your own. All of this over every cycle, you're making your own more and more. And I think, everyone on this is a good example of how we're all trading the same kind of concepts, but we've made it our own and execute it in just different ways.
Yeah, no, that's a great point. Let's end with some sports talk. John, if you want to make fun of Irusha's Raiders, this is your opportunity. So what?
John made plenty of fun of my USC team. You know what? USC is totally open for criticism this year.
Right. Are they under? Is USC under the salary cap this year?
No, they're not.
They're not. So, John, what's it? You follow
you know what they. This is what we used to do with. You'd basically put it out there, Joe, American Express, because it's got the Trojan on there. So they'd all be sitting there, da, 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 da.
That's awesome.
So, John, what's the deal? You follow football more than anyone on here. Some stadiums, I know, and unfortunately, the new stadium in Vegas, there's no fans, but other stadiums are doing 10 to 12,000. I mean, is there a universal thing, or is it just every team's on their own for football?
I don't think there's a universal thing yet, Joe. And, I wish Abbott had that 15-minute, $5 COVID test out there in size already at all of those locations, because, that would be great. But I think the four of us should be going to an SEC game this year, or at least hanging out in the parking lot. Can you imagine if they only let, Alabama holds 110,000 now. They've expanded the stadium. So it holds, I think, 110, 112,000. If they only let 10,000 people in, there'll be 100 and some odd thousand out in the parking lot. The best party in Alabama.
God, yes.
Our friend J.C. Peretz took me to Miami, Florida State, down in South Beach.
Wow.
To a tailgate. It was the DJs, and it was just the greatest thing I've ever seen.
Oh, have you ever been to AT&T Stadium, Cowboys Stadium?
No, it's on my list. I'd love to go.
Yeah, that is great. They have a country western entertainer on one side outside the stadium, and on the other side, rock band. And inside, it's kind of like Dawn Till Dusk, that movie with Dusk Till Dawn, with
Clooney and
with George Clooney and Quentin Tarantino.
Yeah,
where
that's
you've
right.
got, it's a combination of the strip club and hell. They've got all these girls on poles inside the stadium, Joe.
Wow.
Imagine that. Now, they're not taking it off, but the Cowboys cheerleaders don't wear an awful lot anyway.
I got to make it to one of those games. I heard Jerry Jones and his whole box goes from 40-yard line to 40-yard line, but in the dead center, he has what's called Billionaires Row, that you're not allowed to sit there. I think you were telling me that, John. Yep. You're not allowed to sit there unless you're a billionaire.
I was lucky enough, and I wasn't sitting in Billionaires Row, but I was lucky enough to be invited there. And I went with Pat Summerall. Pete and I were friends with Pat.
Yeah.
So we went with Pat Summerall, and he took us to the game. So we met Jerry. And his box goes from the 40 to the 40. And then he's got a private little crow's nest that, like a spiral stair or an elevator, I don't know which, because he doesn't let anybody go up there but him and his sons. And they go up to the top, and allegedly they can listen to the plays being called from up there, only on the Cowboys sideline.
This sounds allegedly very Bill Belichick-ish.
But so they go up there.
And you wonder why I get so many haters. I'm just making fun of every team. But anyway, go ahead, John.
Literally, Joe, they had Bob Lilly was in the box, but Mark Cuban, and most of the Walton family are in Billionaires Row. And he'd sit there and point out and say, yeah, that's Mark Cuban over there. And I said, yeah, I know him. I'm not his best friend, but I know him.
No, you know him from the show. Yeah, he's on all the time.
And that's Jeannie Walton, and that's Sally Walton, and that's blah, blah, blah Walton. They're all billionaires in the front row of his box. And you're just going, where did I start?
All right, let's close it out with some words of wisdom. I don't know, on the markets or whatever, anything that's on your mind. If I don't know, Brian, if you want to go first.
I'll just say the same thing I always say, only price pays, manage risk. It doesn't have to end badly. Just, know your time frame and your risk tolerance.
Very, very wise.
Pretty basic.
Irusha, what do you got?
Respect relative strength. This has been a great market for relative strength, and always, that's how I've just kind of been separating what stocks to invest in, which ones have the most relative strength, and they've kept getting stronger and stronger. And then in the end, just be disciplined. Do not get emotional. Try to be disciplined. Let the stocks set up before you get into them, or you're going to get shaken out, and you're going to get emotional, get shaken out, and then they're going to take off without you.
Yeah, no, that's great. I'll just leave it at "Don't fight the Fed" because I don't know what else to say. Marty Zweig had the greatest line years ago, and it still holds true. So, John, if you got any words of wisdom for all the great people out there?
Yeah, I think Brian had a great one when he said, what do you mean it doesn't end well? Who says it ends?
Right.
Obviously, bull markets, bear markets, those start and stop, but the market doesn't end. It'll be back tomorrow. So my advice has always been for our traders to not ever lose big. Don't ever lose so big that you can't come back. In other words, don't bet at all. They call that an airline trade or whatever, where you put it all on black, and then if it works, great. And if it doesn't, you've got the ticket in your pocket to the to Sao Paulo or wherever the hell you're going to hang out. But yeah, don't lose big because it doesn't end. You can always make money back. And by the way, here's a good one for Joe Fahmy. Mississippi Grind. It's a movie with Ryan Reynolds and Ben Mesrak. I think
Okay.
it's a new movie with those two. It's about gambling. It's about degenerate gamblers.
I'll have to check it out.
Something none of us know anything about.
I know nothing about. I watch Rounders like every other day, but other than that, I'm kidding.
You'd like it. You'd like it. I'm not saying it's as good as Rounders, but it's really good about degenerate gambling, and it kind of puts it in perspective.
No, it's very wise. I think it's very similar to when you read the Market Wizards books. They all have the same cut your losses, cut your losses, cut your losses. It's like location. Those are your, it's the same type of thing. And a lot of them have that lesson because they've been through it, and we've all been through it. And like Irusha says, you make those adjustments and you learn from them, and it's a constant learning process. So
true.
Guys, I can't thank you enough. I've enjoyed this conversation.
Same here, Joe.
And I appreciate you guys for hanging out. We'll post it up on YouTube and Twitter. I'll send you guys a link and so forth. Thanks for hanging out today, and we'll do this again soon.
Sounds good. Thanks for having it, Joe.
Yeah, thanks.
No problem. All right, take care.
Okay. Bye, guys.